XRP and XLM have been performing well lately, penning many new partnerships and agreements. But macroeconomics, interest rates, Federal Reserve taking money out of your pocket, yes, all of those things are having a larger effect on price than the native token's actual projects. And how many of you were told that crypto was a good thing during inflation? Well, let's learn why this was false and learn why macroeconomics are ruling the roost. All right, so first I'm going to show you that it doesn't matter the crypto that they have been trading as a lump sum. So now I've got XLM, Doge, Bitcoin, and Mana. Yes, 4 completely different cryptos out there. And look, they all have followed the same pattern, right? Luna UST crash brought everything down. And then you can see this next pull down right here, more CPI inflation data. So how is this affecting the prices? Well, it all has to do with capitals, how much money you are spending. So now the Fed out there, yes, has been raising rates for a while. Now we're going to talk about home loans, everyone. So now we're going to pretend that we are going to buy a home like many young investors out there into crypto, they buy homes. All right, so this $200,000 loan, remember this has to do with the Fed raising rates, taking money out of your pocket, which hurts the available capital in crypto projects like XRP Xlm. So this $200,000 loan, 30 years, 4%, will cost you $954 a month. The total amount of interest you would pay is $143,000. That is $143,000 that goes to the banks. That does not go into your pocket. So now the Fed comes out, raises rates 75 basis points. Boom, that same house now is almost $1,000 more a month with $32,000 more that you pay to interest in banks. So it's almost $3,000 a year on average that instead of being able to go to crypto, food, bills, car payments, nope, that goes into interest just for your home loan. Now the Fed just hasn't raised rates once. They've raised rates twice now really heavily. So that same home of $200,000 with those 2 75-point rate hikes gives you 1.5 percentage point increase. That loan now, instead of being $954 a month, that loan now is $1,135 a month. Now check this out. The big key is, and a lot of people don't pay attention to this, the total interest on that home now is $208,000. That's $208,000 that's pulled out of the economy, skips all that, goes directly to the bank. So you can see with the home loan, when the Fed raises rates, that pulls more money out of your pocket, money that could go to buying things like crypto, other investment stocks, right? Technology stocks. That's why you're seeing the whole market coming down because of available liquidity from the retail side. Now, remember, this affects home loans, home equity line of credit, auto loans, student loans. So all of the, credit card loans too. So all of those payments out there now will start going up, and up as inflation is just going out of control and the Fed has to raise rates. Remember, we were always told, hey, guess what? Crypto is a great fight against inflation. No, actually it is not. It is a more risky asset class that as you pull liquidity out of the market, the whole entire crypto market shrinks. Now let's move on to businesses, because it's not just retail pressure that we're seeing on a macroeconomic level, it's also business pressure. So that's how you see money gets pulled out of the retail segment. But what about the business development segment, right? People developing in the crypto space. Let's say they want to take out a loan, and this could also be in the tech space too. They want to take out a business loan. We'll make the numbers easy. 10 million, 8 years, 6%. That is 2.6 million in interest they pay that cannot go to employees, that cannot go to innovation and equipment, technology, anything like that. Again, that gets eaten up by interest rates. Now the Fed comes out, raises it 150 basis points over these 2-month time periods. So now that $131,000 a month payment with 2.6 million % paid in interest now changes to $138,000 and 3.3 million eaten up in interest. The big thing here is, again, that's extra capital being pulled out of the crypto market on the business development end. Now with Ripple Labs, XRP, and Stellar, Lumens, XLM, they have done some amazing things with their partnerships. But again, those macroeconomic conditions, pulling the liquidity out of the market on both the retail and the business development side will hurt the growth of crypto. This is where the companies that have great asset management, they can hold their balances really, really tight. They can get those really good P&Ls, a lot of cost cutting. The companies that can do this will weather the storm and will be fine. But right now, the reason why you are not seeing positive price movement for XRP or XLM has to do with overwhelming macroeconomic factors. So no, crypto is not a great hedge for inflation. Crypto right now has to do with the amount of capital flowing into it. And as those faucets get turned off, you will see more projects fail and you will see more money pulled out of the system. Never a good bet for inflation because it was just too risky of an asset class.